Welcome to the Deep Dive. Today we are taking on, well, one of the most compelling corporate transformation stories we've seen in finance recently.
They really are.
We're distilling the critical insights from a whole range of sources, detailing a massive financial turnaround. We're looking at a major bank that, spent years in regulatory purgatory.
Is now attempting this high wire act.
A high wire act, exactly, balancing brutal internal efficiency with some really aggressive, high-stakes growth targets.
And that's the core tension we need to unpack for you. This isn't just a story about cutting costs. It's a detailed blueprint of how a company shifts from focusing obsessively on remediation.
Which ate up so much time and money.
Right. Years of consumed resources and, frankly, constrained potential. Now they're shifting to focusing purely on achieving what they call best-in-class returns. Our mission is to show you where they cut to the bone and where they are rapidly investing all that cash.
Okay, so let's unpack this. We have to start at the foundation, because before they could even think about growth, they needed freedom. And the sources they're crystal clear on this. The single most pivotal moment in this whole story was the Federal Reserve finally removing the asset cap.
Yeah.
For a company of this scale, that's when the handcuffs really came off.
It truly was. And what's fascinating here is that this removal wasn't just handed to them. It was the direct payoff for years of intense, often painful work.
Right.
The sources specifically highlight that since 2019, they successfully closed 13 different regulatory orders. That is an enormous amount of institutional cleanup.
And that matters so much because the asset cap essentially told them, you cannot grow. They were completely constrained.
They couldn't issue more loans, couldn't hold certain assets.
Exactly. But pivots like this are expensive. So this massive strategic shift, it had to be funded somehow. And it was funded by an immense, sustained drive for efficiency.
Precisely. They didn't borrow money for this. They cut the check internally using just brutal expense discipline. And when you look at the numbers, the scale is just breathtaking. We are talking about 22 consecutive quarters of internal headcount reductions.
22 quarters. You just have to stop on that number. That is 5.5 years of continuous reduction.
Think about the discipline that takes. The headcount is down over 25% since the second quarter of 2020. This massive, sustained shrinkage is the engine.
The engine for everything else.
It's the engine that created what they call positive operating leverage in 2025.
Okay, let's pause on that term, because positive operating leverage is the technical proof that the strategy is actually working. It just means their revenue is growing faster than their expenses.
That's it. It shows they're not just cutting costs randomly. They're successfully making the remaining operations more productive, more revenue generating. They achieved that. And this consistency, this 5-year commitment, that's the foundation that allows them to get to the 2025 headline results.
Which brings us to the payoff. And you can see the momentum so clearly in those 2025 results. Net income jumped to $21.3 billion.
A huge number.
A huge number. And the measure shareholders watch most closely, diluted earnings per share, that grew 17% year over year.
And what's so critical is that this growth, it wasn't solely driven by massive cost cutting. Revenue generation was strong. Fee-based revenue was up 5%, and they specifically call that broad-based.
So healthy across the board.
Yeah, which suggests health in both consumer and commercial businesses. It reduces their reliance on any single, volatile segment.
Okay, so let's tie this performance directly back to that regulatory freedom we talked about.
Yeah.
What did lifting the asset cap actually let them do with their balance sheet? Because that's where the power shifted.
It let them finally deploy capital aggressively. Total assets grew 11% year over year.
Wow.
And this wasn't just accidental growth. It included broad-based loan expansion and, crucially, higher trading assets designed to fully support their customers in the capital markets division.
And deposits were up too, right?
They saw deposit growth in both commercial and consumer segments, yeah. It signals a strong return of confidence and activity.
So when a company generates that kind of profit, frees up that much capacity, the next question is always capital management. What are they doing with all that excess capital?
Well, they returned a substantial amount, $23 billion of excess capital to shareholders in 2025.
$23 billion.
Yeah. It was a mix of increasing the dividend per share by 13% and also repurchasing $18 billion in common stock. That is a massive signal of confidence.
The sources also indicate that they expect share repurchases to be lower in 2026. Now, that sounds a little backward. If profitability is going up, what's the strategy there?
The pivot away from buybacks is explained by the fact they now have, and this is their quote, many opportunities to grow organically.
So they're putting the money to work internally.
Exactly. They're going to deploy that capital inside the business instead of just returning it. They're prioritizing funding new loans, new business lines. They manage this whole balance by targeting their Common Equity Tier 1 ratio, their CCT1 ratio.
And for you listening, that CCT1 ratio, that's the core measure of the financial cushion regulators require them to hold. It's high-quality capital.
Right. So managing to that target range, which is about 10 to 10.5%, gives them the flexibility to both fund all this new growth and still return some capital. They're keeping the gas pedal down while maintaining a really robust safety margin.
Now let's shift to the health of the customers who are generating all this cash. The sources noted that credit performance was robust, and net charge-offs actually declined 16%.
Yeah, pretty impressive.
But this is where the analysis gets really interesting. It moves from just reactive risk management to something much more proactive.
This is a genuine aha moment in the material, I think. They realize that only looking at loan delinquencies, that's old school.
Right.
Instead, they're monitoring this broader behavioral data across all their checking accounts, which gives them a real-time early warning system.
They're doing checking account forensics. That's what they call it. They're tracking specific flows, unemployment benefits, direct deposit amounts, overdraft activity, even payment outflows.
Think about that level of detail. They are looking for subtle signs of financial stress before a customer misses a credit card or a mortgage payment. It's a huge strategic shift.
So what did they find?
Well, the finding was confidence-inspiring. They observed no meaningful shifts, which suggests their core customer base is resilient. And that allows them to keep investing aggressively in their consumer businesses.
Okay, so let's detail those investments, starting with credit cards. This is clearly where a lot of those efficiency gains are being funneled. They opened nearly 3 million new accounts in 2025.
Which is up 21% year over year. That's aggressive.
Very aggressive.
But they stress they maintain their credit standards throughout. And this growth is starting to really pay off. They use the term early vintages.
Right, which just refers to the first groups of new card products they launched a few years ago.
Exactly. And those initial groups are always costly, right? You absorb all the upfront marketing and setup costs.
Sure.
But after 2 or 3 years, those early vintages mature and the revenue starts to finally exceed those initial costs. They're now contributing meaningfully to profitability.
We also saw growth in their auto business. That was a segment they had pulled back on during more volatile times.
Yeah, they returned to growth there with a 19% increase in loan balances, and this was really strategic. It was focused on quality partners. The sources highlight a key partnership they made in the spring of 2025.
This was the Volkswagen and Audi deal.
That's the one. Becoming the preferred financing provider for them in the U.S., this shows targeted, high-quality growth, not just chasing volume.
So we've seen where they are investing, but transformation is also about subtraction, about simplification. And for that, we have to look at the home lending business.
Which has undergone, severe strategic surgery.
It really has.
This is a textbook example of shedding complexity and risk. The sources document this ruthless focus on profitability over volume. Over just the past 3 years, they reduced headcount in home lending by over 50%.
Over 2%.
And the amount of third-party mortgage loans they service was cut by over 40%, including a staggering $90 billion reduction in 2025 alone.
So they're shedding that high-volume, low-margin operation. What's the new plan for that business?
The new focus is hyper-targeted. They're only serving their existing bank and wealth management customers. They're sacrificing massive volume to drastically improve their margins and their ability to cross-sell to their most valuable clients.
So while they're simplifying there, they're heavily investing in serving their affluent clients with what they call Wells Premier.
And the momentum is really accelerating here. They increased the number of licensed bankers, grew their branch-based financial advisors by 12%, and the tangible result, Premier deposit and investment balances grew 14% in 2025.
But the biggest high-and-stakes bet has to be the investment banking push. Their stated goal isn't subtle at all. They want to be a top 5 U.S. investment bank.
That's an immense ambition. You're placing yourself against the absolute giants of the industry. The good news is the momentum is building. Investment banking fees grew over 25% in 2025.
Okay, but how do we measure that in the marketplace? What's the proof?
You look at the M&A rankings. They advised on two of the largest M&A deals of 2025, which propelled their announced U.S. M&A ranking from 12th in 2024 all the way to 8th.
In a single year.
In a single year. Climbing 4 spots like that, especially among the largest deals, shows their efforts to attract top talent are really paying off.
And they say their deal pipeline entering 2026 is, quote, meaningfully greater than it has been at any point in the last 5 years.
Which suggests this momentum is sustainable, not just a one-off hit. And this whole push, especially in trading, was completely dependent on that asset cap getting lifted. They could finally use their balance sheet, increasing trading-related assets by 50% in 2025.
Now that sounds like a rapid, maybe massive addition of risk, but the sources do clarify the nature of those assets.
They do. These new assets were brought on to accommodate customer trading flows and financing, and the sources specifically state that while many of these assets are lower margin, they're also lower risk and less capital intensive. It's a necessary move to support high-value clients.
So after all of this, the regulatory cleanup, the efficiency drives, the surgical cuts, the ambitious investments, what does it all mean for the ultimate metric of success? Return on equity, or ROCE?
The ROCE trajectory tells the entire story of this turnaround. If you go back to Q4 2020, their ROCE was a paltry 8%. They initially targeted 10%, then they raised that target to 15%.
And they hit that revised 15% target in 2025. But they didn't stop there. They immediately introduced a new medium-term goal.
A new target of 17 to 18% ROCE. That is a truly huge jump from where they started. It positions them firmly among top-tier peers.
What drives that confidence? I mean, is 17 to 18% actually sustainable?
It's the summation of everything we've just talked about. The confidence is driven by maintaining that expense discipline, the 22 quarters of cuts, while finally realizing the revenue benefits from all those strategic investments, like the maturing credit cards and the higher investment banking fees.
But they did include a smart caveat.
Yes, they acknowledged the path and the timing depend heavily on external factors. Interest rates, the macro environment, and of course, the future regulatory landscape.
Now, what's most telling to me is that 17 to 18% is explicitly stated as not our final goal, but another stop along the way. The ultimate returns they're aiming for are even higher than this new target.
The overarching narrative here is just successful execution under immense pressure. The 2025 results prove they transitioned from a defensive stance to an offensive, growth-oriented strategy. They cut headcount by 50% in home lending to fund a 25% fee increase and a climb up the rankings in investment banking.
And that transformation story is so crucial for you, the learner, to internalize. Corporate revitalization isn't about maintaining everything. It's about being ruthless in sacrificing complexity in some areas so you can be ambitiously successful in others.
Absolutely. And as we leave you today, let's go back to that final goal. The sources clearly said 17 to 18% ROCE is not the end game. So the provocative thought we want to leave you with is this. Considering those external factors they mentioned, the regulatory environment, macroeconomics, interest rates, if they maintain this level of surgical efficiency and targeted growth, what specific operational limits or external macro factors would ultimately prevent this company from finally reaching those absolute best-in-class returns? Something for you to explore as you connect these dots.
Catch you on the next deep dive.